All right, if you pay taxes here in the US, you're going to want to listen up. There's a massive piece of legislation called the One Big Beautiful Bill Act that is set to completely change the game for your 2026 tax return. So in this explainer, we're going to break down exactly what this means for you and for your wallet. And I'm really not exaggerating here. This is not some small tweak we're talking about. The One Big Beautiful Bill Act, or OBBBA as it's being called, is a major overhaul of the tax landscape for individuals and families. So let's dive in and get you ready for what's coming.
So here's our game plan. First, we'll get a handle on this new tax landscape. Then, we'll dig into the single biggest choice you have to make, standard versus itemized deductions. After that, we'll uncover a really powerful strategy called bunching. We'll cover some brand new deductions to look out for, and then we'll wrap it all up with a simple action plan for 2026. Let's get to it.
Okay, first things first. This new tax landscape. What is this law really all about?
Well, this act, which was passed back in July of 2025, does two main things. First, it takes a lot of the temporary tax changes from a few years ago and makes them permanent. But, and this is the big part, it goes way further, introducing some fundamental new rules that are going to impact pretty much every single taxpayer. Think of it less like a new coat of paint on the tax code and more like a full-on gut renovation. All right, let's get right to the heart of the matter. This is probably the single most important choice you'll make when you file your taxes. OBBA completely changes the math on whether you should take the standard deduction or go through the process of itemizing.
So, every single year, you have to pick one of these two paths to lower your taxable income. Path 1 is the standard deduction. It's a simple, no questions asked amount that's set by the government based on how you file. Path 2 is itemizing. That's where you add up all of your specific eligible expenses, things like mortgage interest, state taxes, and so on. The goal always is to pick the path that gives you the biggest deduction possible. Why? Because a bigger deduction means you pay less in taxes. Simple as that.
And here is the first massive change from OBBB. Just take a look at these new standard deduction amounts for 2026. For a married couple filing jointly, that number is now $32,200. That is a really high bar to clear. It means for a whole lot of people, taking the standard deduction is going to be the easy, obvious choice.
But, and this is a huge but, for people who can itemize, the change is even bigger. The cap on deducting your state and local taxes, what everyone calls the SALT deduction, has literally quadrupled. It is jumping from that old $10,000 limit all the way up to $40,000. This is an absolute game changer, especially if you're a homeowner in a high-tax state. Now, of course, there's a little bit of a catch. This huge new SALT deduction isn't for absolutely everyone. The law has a phase-out built in for higher earners, so once your income, specifically what's called your Modified Adjusted Gross Income, or MAGI, creeps over that $500,000 mark, that $40,000 cap starts to get smaller. It's really designed to focus the tax relief on middle-income families, which makes planning a bit trickier for folks at the top.
Okay, so you have these new, much higher thresholds, and that makes a really clever strategy called bunching more valuable than ever before. This is especially true if you make charitable donations and you find yourself sort of hovering right around that new standard deduction limit. The concept behind bunching is actually pretty simple when you break it down. Instead of giving the same amount to charity every single year, you bunch, or you cram, several years' worth of donations into one single tax year. And why would you do that? The goal is to create a big enough pile of itemized deductions in that one year to easily sail past the standard deduction. Then, in the other years, you just take that nice, high, easy standard deduction. It's all about being strategic with the timing. Okay, I know that sounds a little abstract, so let's make it real with a case study from Deaf Giving 360. Let's meet Allison and James. They're a married couple, they file their taxes jointly, and every year they have about $13,000 in regular deductions from things like their state and local taxes. On top of that, they're consistent givers. They donate $10,000 to charity every year. So that gives them a grand total of $23,000 in potential itemized deductions. Now, under these new 2026 rules, their $23,000 in deductions is way below that new standard deduction of $32,200 for a married couple. So if they just keep doing what they've always done, they'll just take the standard deduction in year 1, and they'll take it again in year 2. Over 2 years, their total deductions come out to $64,400. That's just the standard deduction taken twice.
But now, watch what happens when they get strategic and use the bunching strategy. In year 1, they donate $20,000. That's both years' gifts at once. You add that to their other deductions, and it pushes their total for the year to $33,000. And what does that do? It gets them over the standard deduction, so in year 1, they get to itemize. Then, in year 2, since they already made their donation, they just take that easy standard deduction of $32,200.
So what's the bottom line here? By simply changing the timing of their charitable gifts, their total deductions over those same 2 years jump up to $65,200. That's an extra $800 in deductions. Think about that. They gave the exact same amount of money to charity, but they got a bigger tax break just for being smart about when they gave it.
Now, you're probably asking the logical question. Wait, does this mean my favorite charities have to wait a whole year for my donation? And the answer is no, absolutely not. This is where a brilliant tool called a donor-advised fund, or a DAF, comes into play. You can put the full $20,000 into your DAF in year 1 and get that immediate tax deduction. Then you just tell the DAF to send out the grants to your charities on your normal schedule, $10,000 this year, $10,000 next year. It perfectly separates the timing of your tax break from the timing of your actual support. It's the best of both worlds.
So OBBB didn't just change the existing rules. It also rolled out some brand new deductions that you are definitely going to want to be aware of for 2026.
2 of them really stand out. First, there's something called the senior bonus, a new $6,000 bonus deduction specifically for taxpayers who are 65 or older. This is just a direct boost on top of any other deductions they might take. Second, and this is a big one for anyone buying a car, there's a new deduction for the interest you pay on a new car loan. It's capped at $10,000. Now, the key rules here are that it has to be a new car, not a used one, and its final assembly has to be right here in the United States, which is likely a move to encourage domestic manufacturing. Okay, we've thrown a lot at you. A much higher standard deduction, that new SALT cap, brand new deductions for seniors and car buyers. So the big question is, what should you do right now to get ready for all this? Here is a super simple 3-step plan to help you figure out exactly how these new rules are going to affect you personally. Step 1, tally up your potential itemized deductions for the year, your state and local taxes, your mortgage interest, your charitable giving. Step 2, compare that total to the new higher standard deduction for your filing status. Which one's bigger? And finally, step 3, if you find yourself close to that standard deduction amount, just run the numbers on bunching. See if packing your charitable gifts into 1 year could actually give you a bigger tax break over time.
And last but not least, and this is probably the most important takeaway of all, everybody's financial picture is unique. Please think of this explainer as your roadmap, but always consult with a qualified tax professional or a financial advisor before you make any moves. They're the ones who can look at your specific numbers and help you put together the absolute best plan for you. So I leave you with this question to think about. Now that you know the new rules of the game, how are you going to change your strategy?